like gangster rap jazz in here. Wouldn't that be something? Post Malone gangster rap jazz. He could do it. That'd be the guy to do it. Hey, welcome to the closing beat, everybody. Happy Tuesday. Ooh, is it a happy Tuesday? Darn them markets, man. You see what's going on today? The sell-off has continued. We are financial advisors here at Jazz Wealth, and we like to watch the markets because a lot of our clients have said, hey, on the next pullback, let's go ahead and scale in a little bit on that, and I happen to agree. So we've been quite busy here lately. I wish and hope that you'll check us out at jazzwealth.com. If you're looking for a financial advisor, we like to say we're advisors for anyone. Right? Doesn't matter who you are, how big or small your account is, doesn't matter to us. We just want to help you keep your dough straight, and there are literally no strings attached. We have nothing to sell but ourselves, as we like to say. So complete fiduciary, and you can see everything about us actually on our homepage, what it costs and everything. I think we're the only ones to do that. Anyways, we're starting our retirement series here at Jazz Wealth, and we're looking at spending the whole month of September focused on only those of you in or near retirement. We're about to become the only advisor that can manage and watch every single one of your dollars for you. So we're going to focus on retirement here, and we'll expand from there. Thank you for those of you that have checked us out and joined us here recently. Do appreciate that. We have free videos actually on our YouTube channel that come out for you, largely focused on retirement right now, but all kinds of different topics you can see through the checklist there. So let's get started with the stock market, because on the right-hand side of your screen, you see some nastiness, right? I don't know how to say it, but we'll go over to the charts. Here's the S&P we talked about during this rally here. You could look at this point of resistance and say, well, maybe that was going to be where we start the pullback, and we ended up getting the 200-day moving average. That's the red line on the charts. We have since seen the pullback to about halfway. It's interesting to see that from this high to this low, we rallied about halfway. See how you can draw the line across and be like, oh, that's about halfway, right? I measured it out for you in one of our closing beat shows. Now we find ourselves about halfway back here. That's a sign of volatility where people are unsure. And you might say, duh, that's kind of a silly thing to say. But anytime you see that in a stock, that means that the tug of war is going back and forth, right? Every now and then the bulls win, every now and then the bears win. There's no real sign of consistent belief in the upside, or like NVIDIA, the downside, right? So we have that in the stock market now, and that's indicated by these 50% rallies, 50% pullbacks as the pattern condenses itself. Technical traders love when that happens, and personally, I hope that happens this time as well. So now that we've pulled back here, this is our opportunity in the S&P to find some level of support. If we do not find some level of support, everyone starts to believe that we come back down to this prior low. I would welcome that. I think if it happens, it would happen really, really quickly. But let's see. We might have any glimmer of good news in the markets that causes us to stabilize in this area. Remember, when we came up to this area, it was not an immediate turnaround and fall. When we came up to this resistance area, it was not an immediate turnaround and fall. There's a good week where you spend thinking, oh, maybe, no, not going to happen. Oh, maybe, no, not going to happen. That's exactly what's happened here. You'd expect the same thing to happen down here. Here's the sad part. On my chart right now, if you look all the way back here, this is in fact 1 year's worth of data. Every candlestick represents 1 day, and so you add them up and you've got 1 full year. We're looking back to August 30th of last year. If we were to go just like this and draw our line right here, anything above the line would be a positive gain. Anything below would be a negative gain or a positive loss. So what you have is, if you've invested in the last year and you've been sitting there watching the market, an index fund, maybe your 401k, whatever, if it's anything more correlated to the S&P, and that's going to be our buzzword for today, if it's anything more correlated to the S&P, you could see you spent very little time with a gain. In fact, over 70% of the time over the last year, you've seen a loss. That becomes depressing to people. It weighs on your decision making. You want to buy the discount, but you don't see the rallies that are anything meaningful. And so that's something to point out. I wanted to show you that if it's been a year since you started investing, you are getting a lot of experience of, darn it, right? I guess I'll average in. I guess I'll buy a little bit of discounted stuff, right? You haven't seen positivity like those of you that saw in all of 2019 and some of 2020, where the market was literally just straight up. I remember in 2019, there were no real pullbacks at all. It was just up, right? So you never even got to feel anything greater than a 5% pullback. We've seen a whole lot more of that here, so you know where you stand. Now, there's nowhere really to go either. Oh, darn it, I don't have it set up. I'll work my way over here, but there's really nowhere for you to go. And, oh, thankfully, this remembered me, so let's do it like this. I'm going to pull this out and try to show you something that I put in our letter for clients over the weekend there. It's going to look a little messy here at first, but I'll bring it in so you can see it. There you go. This is our Notes from Jazz section, and every weekend I write a letter, and sometimes Eric writes them as well, where I just try to highlight different things and get you updated on where the market's at, what are we thinking about here. And one of the things I want to show you is down here. Oh, perfect. It's actually kind of nicely shown. What I was trying to show here is that there's been nowhere for you to go if you are a allocation type investor, meaning, I don't know, 70% stocks, 30% bonds, 60% stocks, 40% bonds. What I did is I took the last 50 years and we put them on a scatter plot because it looks a little bit better this way. What you have is anything to the right would be gains in the bond market. Anything that is up would be gains in the S&P. Anything to the left would be losses in the bond market, and anything down would be losses in the S&P. So if you were to the right and up, that is the bulk of the time where you see both gains in your bond portion of your portfolio and the stock portion of your portfolio. For example, I didn't put the years except for over here, but we come on over here. Whatever year this is stands out. It was a gain of over 15% in the bond market and a gain of about 3% in your S&P if you were in the S&P, right? So the majority of the time, we enjoy this safety of having an split allocation in our portfolios. What's happened lately is to the left and down means that you have losses in your bond positions, the 40% assuming, this is a 60-40 model, and you have losses in the stock position because you're down from well, we know we're down for the year. And this was over the weekend, so naturally we've fallen a little bit more. How many times have you had to go through a year up to this point, right? We said year to date. It's highlighted right here, year to date. So we're not saying the full year. Every one of these is also year to date as well, up until this weekend, actually. And so from January until this last weekend, we know that our bond positions have lost, and the S&P, of course, has lost as well. That means there's nowhere really to hide. It means if you said, I'm going to be a bond investor because I'm worried about the stock market, and you did this last year, you're losing. If you said, I'm going to be a 50-50 investor because I'm worried about the stock market, you're losing, right? So don't beat yourself up if you look at your 401k and you say, oh my gosh, this is brutal. The bonds are dropping and the stock market's dropping. That has, in fact, happened only 3 other times, 1981, 1974, and this got cut off. That's 1973. This, by the way, you could see quite easily, is the worst bond market performance. Right? Because we're to the left of any other scenario. Over here would be the worst stock market performance relative to bonds there. And again, this is not for the full year. So if you look at 1974, you're going to go, wait a minute, that doesn't add up. That's as of almost the end of August there. So really nowhere to hide, and that's 50 years scatter plotted on your screen there. So again, what do? Right? You sit on your freaking hands. That's what you do, because there's no good reason for you to say, this is it. This is my moment in time right here. The market's going to bottom forever and it's going to head lower. I'd better get a lot of money put to work. It is now the time where I would agree you could start going more lump sums, right? And not being too scared of going a little more aggressive versus something like this over here. But now you've got, you know where you stand there. Oh, I want to add one thing to this. As of yesterday, the correlation between the bond market and stock market is at 0.87%. In other words, it's 87% correlated to the stock market. That's over 200 days. I tried to go as far as I could. 200 was as far as I wanted to take it. So it means that over the last 200 days, there's a very good chance, almost 9 out of 10 days, the bond market and the stock market almost went 1 for 1. Not perfect, but almost went 1 for 1, right? Huge correlation. That is not normal for you to actually see that. We will expand on that in our Notes from Jazz this weekend for clients, because I started going down a rabbit trail and figuring out, like, what does that mean and how often does that happen and what was going on in those years. So I'll share that with you in our Notes from Jazz this weekend. All right, moving on. In the markets here today, you know there's a pullback across the board. Not really much to talk about there. 9 of 11 sectors in the stock market were officially lower. No, by the end of the day, Actually, they all finished lower, but 8 of 11 actually finished down 1% or more. The worst performer today was, there we go, was energy. And I don't think anybody really cares, right? We like that. Oil fell, erasing all of yesterday's gains. I told you, this is a tricky one. I would still maintain this is trying to change directions, change trend. We talked about that yesterday, but this just goes to show how difficult it is, and I say this all the time, to go counter trend the oil market. Super difficult. If I could help you avoid losses, that means almost more to me there. And so because you have oil today, lower on the day, you have energy as one of the weak spots. Now, a lot of that is overbought pullbacks. ExxonMobil, slightly overbought pullback. What were some of the worst ones today? ConocoPhillips, overbought pullback. It's not weakness. It's not catastrophe, chaos, bear markets, and all this stuff. It's overbought pullbacks. They got a little, the rubber band was stretched a little too far, and in order to continue it, to maintain its shape as a rubber band, you got to ease up a little bit, right? So that's exactly what that was there. Not much to really make of that. Let's go back over here. Looking around. Come on. Brother can't type today. There you go. Basic materials there. Continuing to pull back. That was the second worst performing area. Utilities and real estate were the third and fourth. I would argue utilities, remember, that's the second best performing sector in the stock market this year. Utilities give you a reason to watch that pullback as well. Financials held up the best here today. Only a 0.5% pullback, which is significant, but not as bad as everything else. And so looking inside of there are actually a few names that stayed positive. Bank of America, Wells Fargo, I think Schwab. Yeah, all right. Schwab almost came in with a 1% gain as well. And then going over to some of the regional banks, this is going to be news-driven. SVB Financial is trying to come off of lows as well. It's a more long, drawn-out downtrend, but look at it change in trends. Everything we talked about yesterday, what defines a change in trend, that has all happened there with SIVB. So what do you say about that? A sector showing relative strength, and when you drill down to it, a stock changing trends or showing relative strength as well there. So that's it. Half of the sectors here today lost a 0.5% or more, and have lost a 0.5% a day on average for the last 5 days. So think of it that way. That's pretty nasty. Pretty nasty. Oh, let's go over to the NASDAQ here. Loses just over 1% on the day. That is also pulled back to its 50% area there. It has now fallen, if we don't talk about today, it has fallen 5% in just the last 2 days. If you add today, you can add another 1.5% to that. That's about 7.5% in the last 3 days. It's really just because of these 2 days here, but 3 calendar days. Just so you know how volatile that is, right? And to expand on that, over the last 5 days, we've lost 1% on average a day. That's not normal. Just so you know, right? If you're new to the markets, new to this channel, this show, whatever, this is a very interesting 5-day period. And I'm going to actually say 2 weeks because we started this 2 weeks ago. So this is not how the market behaves. And I would say the same thing if it was going up. If the market was going up this fast, I'd be encouraging you not to get too excited because it's not normal, right? This just doesn't happen. It's happened a lot this year. So, you know, you're getting your practice in, but certainly something to say, I'm a part of an odd time in history. This is not the norm in the stock market. It's not the norm in, well, you know, right? Go back over to this real quick. Here's your returns, right? It is not the norm to be down here, bonds versus the market. It is the norm to be somewhere in this area right here, right? And that's the same thing for the stock market. Cool. All right, quick breakdown of the sector. Oh, no, let me go over here. Oh, hold on a second. You have, we talked about oil. You got gold pulling back a little bit more. Remember, that's a almost, like, why would you even look there? That has been a very tricky area to be at the moment. And by the way, that bleeds over to gold miners. Very tricky space to be. We talked about Newmont yesterday. That's officially a new low. Just go do something else for a while, right? No need to be there. All right, let's take a look at the stock market sectors based on a couple different metrics here. Shall we? We shall. All right, this is really simple. This doesn't need to be drawn out. We can make this very, very quick here. But here is the stock market by sector. And when I say stock market, I'm saying the S&P by sector and their current dividend yield. So for example, over here, all the way to the right, in black, you have the S&P currently yielding 1.62%. I don't know if that's attractive to you, or if you don't care. I don't know, but there you go, 1.6%. The worst at the moment is consumer discretionary. And by the way, if we look year to date sector-wise, you go, whoa, you're paying me, 0.84%. I get it. It's normally a growth area. Consumer discretionary is the second worst performing sector year to date, down 23%, and you're getting a whole 0.84% in terms of a dividend there. The worst is actually communication services, down 30% year to date. You're getting a 1% yield. What I want to do is highlight real estate, utilities, and energy. We know energy is the best sector by far. It's up 50% so far, just this year, right? 50%. You're getting a 3% yield on that one. But yield doesn't always mean it's time to buy, right? I always use that analogy. Technical or fundamental analysis tells you why you might want to buy something. Technical analysis tells you when you might want to buy something. Well, you can use a combination of both, and everybody usually does. But if I said, for example, hey, the best yielding sector is the real estate sector, do you think you buy it now? Does that mean like go for it? Or you heard a minute ago, real estate's pulling back. Oh, maybe I want to buy that. You heard me mention utilities. Hey, that's a nice pullback, second best performing sector, yada, yada. Maybe I'm interested. But should you? One of the things you can look at is over in the fundamental space, right? A fundamental world where we're looking at financials, valuations, and earnings and things like that. There's a million things you can look at. So let's take these. Let's go over and look at the current trailing PE ratio of every sector, as well as the S&P. And see if we don't get excited. So real estate's the first one. It's trading at 40 times trailing earnings, or it's trading at 40 times earnings, right? So here you have something that is more expensive fundamentally than all the other sectors. I'm not saying it's expensive relative to itself. I'm saying it's expensive relative to the other sectors, right? But it pays the highest dividend yield. So do you buy that? Right? You may think twice about that, right? You may need more information, want to dig a little bit deeper. You go, well, 40 times earnings, is that high relative to itself? Throwing numbers out there. Does it normally trade at 80 times earnings, right? Just to exaggerate here. Does it normally trade at 20 times earnings? And this is therefore 100% higher than it should be. At that point, you go, well, I don't care if it's paying me 3% in total yield. It's as expensive as it's ever been right now, even with this recent pullback, right? So it's a good lesson on using fundamentals versus the attractive headline sort of things. Like you're going to see real estate yielding 3.12%. Don't just rush into it. Don't go diving over there and getting all kinds of excited. You go, well, fundamental basis, this thing's a little bit pricey here, huh? I've got some problems with this, right? All right, who's logging in as me? Come on now, these people. You're making it. Is that you? No? Somebody's got to fess up. It's probably Eric or something. Anyways, I just wanted to do that real quick with you. Now, you can take a look around just if you want to see. All these sectors we use the ETFs for them just to make it easy, because you can't really pull that from the sector itself. So looking at the current dividend yield, you can see where everything stands. Decent yields across the board. I would argue that some of them are decent or getting better even with this pullback here. So put that into current day's perspective. Total earning PE on a trailing basis here, S&P is sitting around 20. It's getting cheaper historically. I believe this number is around 26. Now I can't think if I'm thinking of something else. So I'm going to say 26. Someone can correct me on that if I'm wrong. I would argue that real estate and consumer discretionary still rather pricey, even after you see the kind of declines that they've had relative to not only themselves, but the rest of the market there. So considerations for you, right? Different ways to look at it. Doesn't mean they're right, just different ways to look at it and get other thoughts and ideas. All right, stocks in the news here today. First Solar. Gee, I wonder who knew this ahead of time. They are going to invest $1.2 billion in American-made solar. Where'd the money come from? Thanks, Pelosi, right? So American-made solar, the money that the government's giving to the EV space and the, what do they call it? The green energy space, it's paying off. They're buying their way into American green energy products there. $1.2 billion. I did not catch where that was, honestly, but it's not in Florida. Anyways, so that's First Solar. Peloton. I don't know, what to say here. They are going to temporarily hold back their 10K filing, which gives essentially their insight into earnings and a couple other regulatory things that they got to do. So normally that's because of some kind of delay, and it's usually outside of their control. It could be that they had technical issues as well. Maybe they were changing the firms that they use, although these guys probably do it internally. I didn't catch why. So actually, I'm going to look real quick because, yeah, it has something to do with their accounting, right? So a little bit of a setback there because they're changing their disclosure. So this is not really a big deal versus someone that may be trying to hide, and this could be the case, I guess, I don't know, but versus somebody that's trying to hide weakness. Right? Sometimes you see that, especially saw that going through 2009 and 10, where companies would delay because they didn't honestly know how much money they lost. Things were moving like that. I don't think that's the case here. Twitter, down about 2% on the day. Elon Musk has been going after them. He's got more, juicy details about why he was getting out of the agreement to buy Twitter. And so that's in the news. By the way, I would say Tesla's in the news too. That was one of the weaker areas today in the consumer discretionary there, because they're going to have to possibly pay up for their automated driving issues there. But that's just part of the game. They had to factor that in. Best Buy in the news there. Better than expected earnings. Same-store sales were down quite a bit. However, they felt that was temporary and that their not pricing power, but their pricing initiatives have been bringing people back to the store. They said just due to COVID, we had a whole lot of sales. Money dries up. We're back to normal. So they weren't really beat up too bad on that news today. Lastly, we got Baidu going over to China here. A little bit of a rough day for Baidu. Earnings were better than expected. It was actually a really good earnings report. Revenues came in better than expected. The main focus for them, unfortunately, the timing of their comments was pretty poor. They had said, we now have the Chinese economy reopening. This is great news. We're actually starting to see an uptick in the number of searches and all that stuff. This is Google of China, basically, with a few sales components on it. And overnight, Chinese government says, all right, there's 2 other areas that we're going to start locking back down again. I think that's part of it, right? Because I didn't see much else there that would suggest that, growth is going to be a problem as it has been moving along. Oh, also, fun fact, they did 287,000 autonomous rides, but there was a human in the car. Wuhan, China is the first to do driverless taxis, essentially, driverless Uber type things there. They're using Apollo Go, that's what they call it over there. And they also they didn't really have a choice, but the delisting agreement has been signed between the Public Accountability Office, some division there, I forget what they call it. And so if Chinese companies comply, they'll be fine. They did mention that in their conference call, saying that's fine. We're willing to address that. And if we are one of the ones that are audited, we'll provide any amount of info that you guys need. That quietly came out on Friday. Did anybody even notice that? Remember when Trump said, hey, we're going to delist all these guys because they're hiding numbers from us? And now this administration will get credit for it if it all works out. That's fine. But it just came out like, hey, we signed a deal with China. All the companies that are listed here, for the moment, we're going to say there's about a 60% chance they can stay listed, provided that they cooperate with some of the stuff that they want to provide, or hopefully provide in their audit. I didn't see that anywhere. I didn't see that news anywhere. And okay, who's out there, right? Look. Interesting fun fact of the day. Your Bed Bath & Beyond, because somebody brought GameStop and Bed Bath & Beyond up the other day. For 9 of the last 12 days, Bed Bath & Beyond has either been the best performer in the market or the worst performer. So coin flip, right? But 9 of the last 12 days, that's been at the top of the list or the bottom of the list. Volatility, right? Don't be emailing me. He was like, well, my retirement account's moving around a little bit more than I was hoping. And I see you got GameStop. I look in your nest egg and we're like, what you doing with Bed Bath & Beyond and GameStop, huh? You worried about volatility, but you got $100,000 all in Best Buy. Or I'm sorry, Bed Bath & Beyond. Come on, man. Who's famous for that? Come on, man. Come on, man. Who? Boomer Esiason? Oh, Chris Berman. Come on, man. I knew it was a sports reference. Look out, man. Look out. All right. We will wrap it up there. That is good. If you haven't been able to tell yet, this is recorded. We had to do it today. We'll be back tomorrow to do this all over again. Thank you so much for those of you who have been looking for an advisor and said, let's give Jazz a shot. There really is no strings attached. I swear when I say that, you have to imagine that if there would be people, countless people online going, oh, he suckered me in and then, something cost me something. We don't do that. No games being played here. All right, enjoy the rest of your evening. We will see you tomorrow and look forward to more excitement. What do you think? Up or down tomorrow? Tell me in the comments. I mean, really, as a coin flip, do you think the stock market will be up or down? I'll throw my guess that it's going to be, I'll be an optimist. I'm going to say up. All right, see you tomorrow.